Good evening. Welcome to the Shadow Trader Video Weekly for Sunday, June 16th, 2013. Happy Father's Day to all the fathers out there. This is a really interesting chart that we're looking at here in the S&P. Very choppy. Lots of 100% retracements, as I call it. You can see here we had the move down to the 1600, perfect touch on the trend line, up, then going over the trend line, the downtrend line, which is relatively confusing, I think, because you would think it would just, if we're going to back off, it would back off below it. Then you retrace about 85 to 90% of that move. Then you have 100% retracement of the prior down move of the 2 days, and then Friday was relatively bearish as the market kind of tried to make a new 2-day high here just by a couple of ticks, and then failed and went down. So my outlook here coming into the next week is definitely, I would say, neutral to bearish. We've got an FOMC meeting happening on Wednesday the 19th at 2 p.m. That's going to be really key. The market's sensitivity to these releases has started to grow recently, right? We went through a period where the market was just kind of up all the time, and the market kind of just ignored the Fed or assumed that everything was kind of status quo. So now we're kind of in a different period where there's a little bit of agita amongst investors, traders, whatever, about whether or not there's going to be the tapering, do they stop the bond buying, etc., will interest rates rise, all that stuff. So we're starting to see a little bit more sensitivity to the meeting. So I think that everything going forward in terms of resolving this pattern is going to hinge upon what happens on Wednesday at 2 p.m. Eastern, okay? Because for now we're sitting on the backside of the trend line, which would be considered bullish. We have support here at the 1608 just below us. What I wanted to point out also is if we look at a longer term chart by scrunching it a bit, notice that we've been riding the same trend line for a lot of touches now. And this is interesting because as the touches get closer, it tells us that the market, that the trend is somewhat weakening, and that's how you see here, you establish your trend line, and then you don't touch until here, so the trend is very, very strong. And here, the time period shortened a bit, so the market got ahead of itself, came back to trend very quickly, and notice how short it is here, where we came to the trend line, bounced only 3 days, and retested it again. So this is a sign possibly that the trend is weakening. The market absolutely positively has to hold this 1615 approximately in the coming week in order for the uptrend to stay intact. If not, we will revisit the 1600 very quickly. You don't see it on this chart here. However, if you look at futures, right, this has already been tested down in here. And I want to make that very clear, because the more times that we test, you see how the futures chart looks different from the SPX chart, because the futures chart references 24-hour data. I just wanted to point out that the 1600 already got tested in an overnight session here on June 13th, but again, you don't see that on the S&P because it actually rallied back up and we opened much stronger. These index charts show right where it opened. It doesn't. There's no 24-hour data in the cash market. So the reason I'm bringing that up specifically is because if we retest a third time, you would think that this area has been considerably weakened by now and we would get a break. Now, if the break in the coming week is to the downside, my target for the S&P is in this area at the 1550. There is a lot of volume in this area on the profile. If you look at a composite over the last 6 months, this is a very bulgy area, for lack of a better word, in the profile, where if you put a histogram of all the volume that went off in the futures, you would see there's different clumps sort of where a lot of volume went off. A lot of two-sided trade went off in this area. You don't even really need to know profile to see that, because it should be obvious to you, because look at the amount of time that was spent here. This is first or second week in March, and all the way over here is the third week in April. So there was a lot of time spent coalescing around the 1550 area, and this move here, which is kind of straight up through it, would probably not offer much support if we were to lose the 1600, especially given that we've got this double bottom here, so there's probably a lot of stop orders sitting right under that 1600. So that's what I think might happen. Now, with the Fed coming up on the Wednesday the 19th, that could be the impetus to push us through, or not. It may actually take the market higher. There's really no way of knowing that. If the market is to go higher in the coming week, Fed or not, I would say the main key is that the downtrend has to break and hold. You notice that we have had only one daily bar in the S&P closing above the downtrend, but other than that, it's just been all failures, right? We went over, failed, we went over, and then we failed again. We can't seem to get a bar closed above here, so I'll be watching for that really closely. I'm going to take a brief look at the profile now and show you some things that are kind of tying in with the choppy action at the very least. I can't really say that the profile is telling us verbatim that it's bullish or bearish, but some things are happening in the profile that are definitely indicative of very poor structure, and that's probably why the market seems to go up one day and come down the next. And poor structure is basically when the profile distributions are very elongated and thin. And 2 days that come to mind really quickly are June 12th and June 13th here. This was the big down day, and this was the up day, and this is why I was saying we're getting 100% retracements, which is very confusing when you have days that kind of mirror each other. And you can see on the down day here, the structure was actually poor at the top. You had a liquidation break from the top here where the profile distribution is very thin, and then you built value at the bottom, so the whole thing looks like a letter B. That's indicative of a liquidation break at the top and less indicative of new money sellers coming into the market. So it's more old business rather than new business. If the market's going to continue and establish a trend, it needs new business to come into the market, meaning that new longs or new shorts come in and they have a longer time frame outlook and they're committed to it and they stay with it and they just kind of keep hammering the market in that direction. On the flip side, on the very next day, which was June 13th, which was Thursday of the past week, we had the opposite action to the upside where we opened relatively low, shot up high, closed high, and look what happened. Poor structure all the way around, thin profile, very elongated. The point of control in volume was at the high of the day. However, the point of control in terms of the amount of time that was spent, which would be the TPO point of control, remained relatively low. So basically traders just got themselves long in the hole up here, and Friday that came home to roost because we had a look above and fail essentially. We went a few ticks above the 3-day high here. There were no new buyers stepping in to power the market higher. That's an important piece of information to carry forward, that the market tried to clear the 3-day high. There was nobody there, and it just collapsed on itself, and then the majority of the trade was much lower. So that's what's happening in the profile. Let me just get rid of this. One other thing I want to show is that in tying in with this action, which is really kind of 50-50 here, we're definitely seeing a lot of divergence in what's going on sector-wise. There's some that are looking bullish, some that are looking bearish. I'll leave it on the daily. Leading sectors on Friday were, for instance, telecom, which has had a pretty big resurgence here, but is not yet, I would say, at even a 50% retracement, so it could turn around. Home builders as well. You notice that there's been these bounces here, which could be indicative of a bottom forming because you have this kind of 100% retracement, kind of sellers shut off. But at the same time, you have a lot of sectors which I think are maybe more key, such as I'm going to look at broker dealers here and look at the daily bar here, where it's just almost 100% of the up move back to the downside. By the same token, look at banks, right? Banks were even more bearish, where whatever action happened on Thursday, it just took it right back on Friday and closed relatively close to the low. Transport, again, mixed bag, right? Because it's a lot more bullish. Notice that the transports went much higher than the 3-day high, and then when they sold off, they only came to the middle of the range. And also, let's look at energy as well. XOI, for example, oil, probably more bearish than bullish because the majority of the bar was retraced. That's XOI. And let's look at one last one. Let's peek at OSX, which is oil services. Again, divergent, only a 50% retracement, as opposed to that's the services stocks, and the drillers were a lot more bearish. So overall, there's just an immense amount of push-pull here, and it's really hard to say what the next move is. I've been tweeting about the fact that my outlook really in the longer term, until this Fed gets taken out of context next week, Wednesday at 2, is really very neutral here because mixed signals really abound. Okay, coming into the next week. That being said, about being more neutral on equities until we see how this shakes out, I am still interested in the natural gas play and the bonds play, and that would be to the long side. And this is good because this is really not correlated with the market very much. Bonds to a degree, but natural gas certainly not. I'm just looking at the trend line play here over the longer term trend line. You can see it clearly on the weekly, and on the continuous contract here. It's in the 360 area, so I'm looking for a buy on natural gas. Remember, you can use UNG as a proxy for this, and then I'm also continuing to watch the support level in the bond futures at the 135 area. We had a probe to 138 on Friday, and then we rallied back. I think we could make it here, and if we do make it here, I'd be interested in a buy. It's probably just for a bounce, but I think it could be a solid trade long at the 135, and then looking for a bounce maybe to the prior lows here around the 140. Okay? Have a wonderful weekend. Happy Father's Day again to all the fathers out there. On behalf of myself and the entire Shadow Trader team here in beautiful Philadelphia, Pennsylvania, I wish you good trading and good night.